What I'm going to do today is I'm going to go deep into what I'm actually doing and how you can be part of the journey yourself, how you can essentially achieve your own financial freedom through real estate investing. What I'm going to do is I'm going to go as real and transparent as possible. And by the end of this, my goal is that you have a very completely different picture of what real estate investing actually looks like. The goal here is to help you understand real estate investing, but more importantly, what it took during my journey to take a step back and realize that the best thing I could possibly do for my own real estate portfolio was to take a step back, strip everything down, and then really focus on what was going to lead me to my overall goal as quickly and efficiently as possible, because that's all that really matters at the end of the day. A lot of people do real estate investing, and I just think of it very differently than a lot of people. I think of it purely from the end goal, which is financial freedom, and then taking a step back and saying, well, what is the best, most efficient path to get there with ideally the least amount of risk, ideally less work to achieve the overall process or to achieve the overall results, even if that means more work on a per deal basis or more work on in any real setting individually, but not on the collective. I want to save my time and effort collectively for the most possible result as possible with the least amount of collective effort need to be put in. It's a little weird, but what I'm trying to highlight here is my journey has been predicated on not buying just a bunch of properties, but more so how can I buy better property, or how can I find better properties, structure them to maximize their returns, minimize their risk, and then achieve my overall end result as efficiently as possible. That's really what I'm trying to help you guys do as much as possible, as opposed to just saying, I'm going to go ahead and buy as many properties as I can. I'm going to own 100 doors, 1,000 doors, whatever, because that doesn't really matter at the end of the day. So before I get into all that, I want to ask you a question. When you first decided that you wanted to invest in real estate, what was the actual image that you had in your head? Not the spreadsheet, not the passive income phrase that you read from somewhere, but what did freedom actually look like to you, right? What did financial freedom look like for you? What does that mean to you in particular? Financial freedom. What does that mean? All right. So what I'm going to do here is I'm going to tell you my journey. I grew up watching my mom do everything right objectively. She immigrated to America. She immigrated to this country, and she raised me on her own. She was a single mom who worked multiple jobs, and she worked constantly. Early mornings, late nights, weekends. And even then, working all the time, she still had nothing left financially at the end of the month. We were barely making ends meet. And I'm not just talking about money, right? That's one big component. She had very little time as well. No flexibility at all with her schedule, and no room to breathe at all whatsoever. She couldn't take a random Tuesday off to come watch me at a school event or go to a parent-teacher event or whatever, because work was the necessity to generate income, to be able to cover the bills so that we didn't live on the streets or run out of electricity or run out of food. So she couldn't say no to a shift. She was trapped. She was working. She was making enough money to cover everything, but she was completely trapped. And that trap looked like responsibility. She was doing what she needed to for us, take care of our family, but it was a trap at the end of the day. And I made a decision while I was watching that I was not going to repeat that pattern. Well, when I eventually left the military, I served as an engineering officer. I was making decent money while in the military in my transition out. However, I quickly realized that the exact same dynamic that trapped my mom followed me into my civilian life as well. When I got out of the military, which we already know the military is it's very restrictive on you, your time, your vacation, your income, all that kind of stuff. It's very defined and limiting, but that's okay, because I knew I wasn't going to do it forever. So then coming to the civilian life, I thought, cool, I'll get a better grasp of this. But it ended up being the same thing. I needed to ask permission to take time off, which, of course, right? If you're working a job, you need to ask to take time off. But it wasn't based on logic if it was approved or not. It was based on how someone else felt at that time, regardless of job responsibilities and all that. It was in someone else's control. It wasn't just based on pure logic. Does he have time off available? Do we have big things going on? Can he take it? It was permission that another adult had to say yes for me to take time off. I didn't like that. And my income was tied to someone else's decision about my value. I didn't like that. It wasn't about how much work I was doing or how productive I was. It was, do they think I'm worth this much money? And will they continue paying me? And whether it was the military or the government that I worked in after, it was still very limiting financially, right? They would tell you, this is what you're going to get. Your raise can only be up to this amount, whatever. At that point, though, especially mid-20s, late 20s, my paycheck did feel like security. And it was security. At least with working just one job, I could create more income each month than my mom created through multiple jobs. So that was great. At the same time, that security was also a leash. Income without freedom attached to it is just a nicer version of the same cage. Like I said, I didn't have to work multiple jobs like my mom, and I had more money left over at the end of the day. However, it was still part of the same cage unless I was learning and investing that towards achieving actual freedom. Because the freedom doesn't come from just earning income. Freedom comes from what you do with that income, how you save, if you're even able to save it, and then how you invest it so that it's continually making you more money without having to exchange more time for money. If you're constantly changing time for money, you're just in the same loop over and over again. Time to make income, to spend on expenses, and then you spend more time to make more money, to spend on expenses, unless you are saving some of that and then investing it. So now your income is being generated by you trading time for money, right? Because that's part of the journey. You have to do that at some point in your journey, unless you were born rich, which most of us are not, especially if you're watching this video. But it was the same cage unless you invested that to be able to achieve that freedom, right? Able to achieve income without having to exchange more time as a result. So when I started investing, my goal wasn't to chase the biggest portfolio. My goal was never to impress anyone with the number of doors I had, the number of properties I had. I was asking myself one question over and over again. What is the fastest, most efficient path to genuine freedom? And that word efficiency completely changed how I look at every single deal that I invest in. I want to know, what is your criteria? What are your cash flow goals? How much money are you trying to make on a per property basis? So for example, drop a yes if you've ever been told that if you're getting $100 to $200 a month per property, that's a pretty good deal. Because that's how 90+% of investors in the residential single family home space operate. They operate with the understanding, as long as I'm cash flow positive, as long as I'm making $100, $200, $300 a month, I have a good deal on my hands. Well, the problem with that is that most investors never really think through the math and the operational components involved with that decision. I want this to actually sit with this. All right. So sit with this, please. If your freedom number, right, if you need $10,000 a month coming in every single month to cover your expenses. So if your freedom number is $10,000 a month of passive income at $200 per door, here's what that path actually looks like. You will need 50 properties at $200 per door will generate you $10,000 a month. That means 50 mortgages, 50 roofs, 50 tenants, 50 maintenance calls, right? Or 50 properties that generate maintenance calls, 50 turnovers when those properties are vacant. If you're generating $200 a month in cash flow and your goal is $10,000 a month in passive income, you need 50 long-term rentals generating $200 per door to become financially free. 50 properties, 50 times going through the full process for that to happen. To me, that was never financial freedom. To me, that was building a second job that owns you even more than maybe your first job did, right? Actually working a W-2, working for someone else seemed like it was a better trade-off. Trade my time, earn money, guaranteed amount, work a job, rather than try to find, analyze, own 50 plus properties to make $10,000 a month. Why? Because even though you're generating that much cash flow, well, then you have operational expenses that are the result of your real estate business. You can't just infinitely grow a real estate business, just add property after property after property and assume that you can handle all the operations yourself. As you stack more and more properties, there's more and more work that needs to get done for the operations. Even if you are delegating property management, even if you're delegating some of the bookkeeping and financials, even if you're doing a lot of that, delegating it out, you still have to oversee all this stuff. That creates a new job that most people don't even want to do at the end of the day. So the question I kept coming back to was simple. Would I rather generate $10,000 a month from 50 properties or from less than 10? The same destination, $10,000 a month, but a completely different path to get there. And more importantly, a completely different life once that was achieved. This is the question that led me to co-living investing. Co-living changed everything for me in my real estate investing journey. So what is co-living? I talk a lot about co-living. So what is co-living? Because there's a lot of noise out there, I want to make sure we're all on the same page and working from the same definition about what co-living is. And I want to make it extremely simple for you because co-living in reality is simple. You just take a residential property, you take any home that has certain property characteristics, and instead of renting the whole house to one family for one fixed monthly rental payment, you just rent them out by the room. You rent each room individually. So instead of renting the whole house, you rent out each room of the house individually. Each tenant pays a flat monthly rate that covers their room, their utilities, which includes internet, and then shared supplies for the property. That's it. You take one property, and now you're generating multiple streams of income from that one property instead of one long-term tenant. So what changes is not the property itself, it's the income model. Yes, you are going to make some conversions to the property, but it's how you're utilizing the real estate property itself. Like I said, my goal is not hundreds, thousands, millions of properties. It's how do I make the most amount of money per investment? There's a combination of things like quality of life for my tenants, the property's appreciation of wealth, but how can I get really great returns from a single investment as opposed to trying to find 10 properties to equate to the same end result? So if I can generate $1,000 a month from a single property, I would much rather do that than have 10 properties generate me $100 each, making me $1,000 a month from 10 properties. So it's not that the property itself is changing, although yes, it is changing because you're buying different types of properties for this to work, but it's just the income model you apply to the property itself. Instead of one lease, one tenant, one payment source, you have 6, 7, even up to 10 independent income streams on one single address, one single property. This property becomes a multi-income machine for you because your goal is cash flow. And ideally, your goal is a efficient cash flow generating investment. It's not about the number of houses. It's about how much money you're generating with ideally the least amount of time and effort over the long term. Obviously, you're going to spend more time and energy finding the right deal, operating as co-living than one single family home, but you're going to spend a lot less doing that with one co-living home than if you do that for 10 long-term rental homes. That's the real comparison. Let me give you one of our real deals, right? A property in Atlanta. This is a real example, property in Atlanta. This was a standard 4-bedroom home. Decent neighborhood, nothing really special about it. C+, B- neighborhood in Atlanta, maybe 15, 20 minutes from downtown. As a traditional rental, rented to a family, right? Rented to a single family with one lease, the rental income was around $2,600 a month on the higher end. So I can make around $2,600 a month of rental income every single month on the higher end as a long-term rental. Well, after I covered all the expenses, the mortgage, the taxes, insurance, all that good stuff, I was losing around $47 a month. That also includes setting aside money for reserves, for vacancy, maintenance, capital expenditures, having property managers in place, all of that, right? I'd be losing around $47 a month. So every single month, that property would be bleeding. It'd be losing money every month as a long-term rental. Well, here's where it got interesting. We instead converted that exact same property into a co-living investment. Same house, same address, same 4 exterior walls. We added a few more inside. But we converted the dining room and living room into bedrooms, and we created 7 rooms from a property that originally had 4. From 4 to 7 rooms. From losing $47 a month, we're able to increase the gross income from $2,600 a month on the high end of a long-term rental to over $6,800 a month as a co-living investment from 7 tenants. after all the expenses, which there are more of, after utilities, over $1,000 a month, management, supplies, vacancy, maintenance, and CapEx, instead of losing $47 a month, this property would net $1,740 a month in cash flow. It's actually exceeded those goals, but based on our initial analysis, we were looking at potentially losing $47 a month as a long-term rental, taking the exact same property, converting it to co-living by adding additional rooms and renting it out by the room. Although our expenses went up, our income went up so much more, from $2,600 to $6,800, that after all the expenses, instead of netting negative $47 a month as a long-term rental, it nets over $1,740 a month in cash flow. $1,700 a month in cash flow. I want you to really absorb that, because if you're actively investing, you've probably seen that it's very difficult for the majority of investors to find opportunities like that. Well, that's why this is called Buy Better Deals. The whole goal is to help you understand how you can buy better deals. That doesn't come from just buying a property. It comes from understanding and structuring, really creating better deals. So it's not buying better deals. You're buying better deals by creating those better opportunities. The reason why I want you to really absorb that is because $1,700 a month, for those who are told you can only generate $100, $200, $300 a month of cash flow as long-term rentals, who, maybe are getting single-digit cash-on-cash returns, or those who are brand new investors who are seeing people throw around numbers like $500, $1,000, $2,000, $500, whatever, $1,000 a month, whatever they're saying. I want to understand what the reality of the situation looks like so you can go into your investing journey or scale it as effectively as possible. Going from losing $47 a month to generating $1,740 a month is around $1,800 a month difference in cash flow. Being able to take an investment, a single property, and create that level of opportunity, that massive adjustment towards the cash flow it could generate by going co-living, is not a rounding error. It's an intentional decision based on your intentional investment strategy to intentionally maximize your property to generate you better co-living returns, much better returns, and that results in a much different life. That is the difference between needing 50 properties to be financially free to needing less than 10. Buying the right properties and structuring them to maximize your returns and the overall operational work around it is the difference between needing 50 properties, even dozens of properties, we'll say, to needing less than 10 to be fully financially free. This is why I tell every single investor that I coach, you don't need more doors. You need better deals, and you need to structure them much better. My personal minimum on every co-living deal I buy is $1,500 a month in cash flow and at least 15% cash on cash return. This is in comparison to when most investors out there are celebrating $150 a month per property. To those guys, it sounds impossible. I'd like to understand from where you guys are all coming from. So have you looked at co-living before today? Or am I preaching to the choir? Because you already follow a lot of my stuff and you understand co-living to some extent and you're excited to continue on this journey? Or it's your first time really getting into co-living? The more you share with me, the more beneficial I can make this training to be customized towards you guys. So whether you are brand new or you're already thinking about converting a property, everything I'm about to share with you applies nonetheless on how you can create better deals. So why co-living works, the 3 structural advantages. Co-living consistently outperforms every single other rental strategy. And it's not because of luck. There are 3 structural reasons why co-living performs so much better than every single other strategy out there for single family homes. Understanding these 3 core concepts will change how you evaluate every single deal you look at moving forward. Advantage 1 is the higher income. When you rent by the room instead of by the full property, you are multiplying your revenue dramatically. A property that produces $2,600 a month as a traditional rental can produce $6,000 to $9,000 a month as a co-living rental. That extra income creates margin. That creates additional profits you can reinvest back into your business, right into your property. That allows for better operations, especially without you being involved with every part of it, faster scaling, so faster achieving your goals, and the ability to weather anything that the market throws at you. income is the number one problem solver in real estate investing. Well, having access to money is the real problem solver, depending on what your problems are. But when you own a property, the number one solver for when things adjust in your property is having a solid spread between your income and your expenses, or a lot of cash flow. When you have more cash flow and solid reserves, when things go a little bit sideways, you're much better protected. Whether you're the buyer, the capital partner, whatever, you're much better protected when there's a lot of excess cash flow in your deals. This is why co-living is so powerful, because it just generates so much more cash flow, and as a result of much higher income per property than anything else in residential real estate. The second key advantage for co-living is that it distributes your vacancy risk. If you have a long-term rental, a traditional rental property, it's binary. If a tenant leaves, your income goes to zero. So if it's rented, you're making money, right? Binary, one and zeros. If a tenant leaves, you're making no income. So all income, no income. There is no in between when there's a single family living in your house. You still owe the mortgage, even if, like, when your tenant leaves and your income goes to zero, you still owe the mortgage, right? You still got to pay that, the taxes, the insurance. But you are bleeding the full cash every single day until you find someone new. Co-living is fundamentally different, like massively different than that. If 6 of your 8 rooms, right? So you have a 75% occupancy, 25% of your rooms are vacant. So 6 of your 8 rooms are occupied. You're still collecting 75% of your income. You still have enough money to cover your expenses. You still stay operational. This stability matters enormously, especially when the market slows down, especially when you have multiple things going on with multiple properties. You want to minimize the income loss, and diversifying your income through multiple tenants in a single property allows that. Then having multiple properties also allows that diversification, but it's better when it's in that specific house as well. It just gives you more stability. And that stability really does matter enormously, especially with my investment strategy. Here's a little story on when vacancy hit one of my properties. Early on, I had a traditional rental go vacant for 45 days. That was one tenant with one lease. Property was vacant for 45 days. For 45 days of zero income on a property that I still had expenses on. That was a massive wake-up call when you're paying $3,000 a month out of pocket until you could find the next tenant. Compare that to a co-living property where I have 2 of the rooms turn over every single month. Well, that property never went vacant. I made a lot less cash flow. Instead of making $1,500 or $2,000 a month in cash flow, we made $200 during that month, but I still had enough income to cover all of my expenses, pay the mortgage, pay all these things, which is the biggest risk in real estate investing. Because if you cannot pay your mortgage, your taxes, your insurance, right, these lead to you potentially losing that investment. Not just temporarily losing cash flow, but losing cash flow indefinitely, all the wealth building that you've done because you cannot keep up with the mortgage. Well, if you have 2 or 3 of these happening at one time, you're really screwed. But if you are diversifying your income between multiple tenants in one house, that stability means that you are in a much less stressed position, even though you might be making less money during these higher vacancies or turnover periods. You still have money coming in to cover your expenses. That's huge. That experience was one of the big reasons that made me fully commit to co-living. The diversification of vacancy or risk between multiple tenants instead of just one, on top of the much higher income, right? So advantage 1 was the much higher income. Advantage 2 is the distributed vacancy risk. Advantage 3 is the massive and growing demand for this type of housing. And this isn't even speculative. It's very well documented and easy to find. I talk about it in basically every co-living training that I do, showing that in most major metro areas right now, so think of any city you could possibly, literally any city in any state, right? A worker making $20 to $35 an hour simply cannot afford a studio or a 1-bedroom apartment on their own. The vast majority have to spend 30, if not 50+% of their income, whoever's making $20 to $35 an hour, to be able to just afford to live independently in that market. Or they have to live so far away, they're spending hours in traffic. Think of Atlanta as a perfect example. If we're driven through Atlanta during traffic, it's the worst. Imagine having to do that going into the city and out of the city like most people do during work time, and still spending 30+% of your income every single month. So shared housing isn't even a compromise for these people. It's the most financially intelligent option available to them. There is no real other middle ground. Either they spend the majority of their money on housing, or they have no housing. They have to live on the streets in a car, pay a bunch more for a short-term rental or a mid-term rental. That's the gap that co-living fills for them. They have an option to still have good, clean, safe housing, although they only have a room, right? A private room and shared common areas. That is a massive advantage for them relative to spending too much of their income on housing or not having an actual housing option unless they're hours away from where they work and where they want to live. So it's like, this is the best solution for them with the way everything is constructed right now in our economy. Platforms like PadSplit and many others, right? Many other platforms that allow for rent by the room options have validated this demand in city after city after city after city. Not only has it been incredibly well established in some of the major markets, but it's spreading like wildfire almost everywhere. Why? Because there is such a huge discrepancy between how much money people are earning and then have to be able to pay for housing relative to how much housing costs continue to increase. People's income is basically flat while housing prices are constantly increasing, whether they're trying to buy or rent, right? So that's what they're facing. This is the solution for them. And this is being more and more and more widely accepted. And it's just a major solution for these people who are struggling with spending on housing. So not only is the tenant pool currently deep, but it's growing and it's growing massively. And depending on your perspective, it's not going anywhere, which is fortunate for us as investors and unfortunate for those that struggle to afford housing, but that's where we come in and we provide them an affordable housing alternative. So the three key factors: higher income, distributed stability, structural demand. These three things together are why co-living outperforms every other residential strategy across every single metric that matters to actual investors. Not just on paper, but in real properties, in real markets, and then generating real returns that you get to actually benefit from consistently. So let's talk about the three rules for finding these great co-living deals. Not every single property works for co-living. On top of that, not every single market works for co-living. The investors who struggle with co-living are almost always making the same mistake. They are trying to force the strategy of co-living investing somewhere it does not fit. By that, I mean somewhere where they don't need affordable housing and you're trying to make it work. The ones who win follow three clear rules, and let me walk you through each one of them. Rule one, the right market. Co-living solves an affordability problem. That means if it only works in places where the problem genuinely exists. You want to invest in co-living in major metro areas where the workforce, people making $20 to $35 an hour, are spending more than 30% of their take-home pay just to rent a studio or a one-bedroom apartment. Think Atlanta, Dallas, Charlotte, Raleigh, Denver, various cities, various states all over geographically, markets that have population growth, strong employment, and housing costs that have greatly outpaced wages. Because not only have they historically done that, and they had a rapid separation between income and housing costs over the last couple of years since 2020, but it's only going to, at minimum, stay the same, if not get worse with time. So how I validate a market before I spend a single dollar is that my fastest validation tool is I use PadSplit. Think of PadSplit as the Airbnb of shared housing. PadSplit is a platform that makes co-living investing a little bit easier, but more importantly, they have so much co-living data available for you on demand and available for free. They're tracking tenant demand, so how many people are looking for co-living in that market, how much active inventory there currently is, occupancy rates, how many of those rooms are full, how many of them are vacant, the average room price by city, by zip code, literally breaks it down by zip code. When I see a market with tens of thousands of unique visitors searching for room rentals, right? So, or even thousands of people looking for room rentals relative to a couple thousand. So let's say there's 30,000 people looking for room rentals versus 10,000 units available for rent in that market, and that they're 90% occupied. I know of that 10,000, there's 1,000 actually available for rent, And there's 30,000 people searching for housing like that right then and there. This is why pad split is so great, because it's not a speculative bet for me. This is documented demand greatly outpacing supply. The number of people looking for affordable housing in that market greatly exceeds the amount of houses and room rentals available in that market. So before I spend too much time and energy or any money trying to invest in a co-living deal, I let pad split validate my markets before I spend a single dollar. If pad split isn't there, I don't want to invest there either. Not because it will automatically be a bad co-living investment, but because it's not worth the risk when there are plenty of markets that are already validated and proven by the pad split data. That filter alone has helped save me from some very expensive mistakes as it comes to being a co-living investor. And this is so much better now than when I started utilizing pad split over 3 years ago, when they had much less markets and much less data. Now, over the last couple of years, there is so much more data available that makes your start or growth in co-living investing so much better and less risk than it was for me. But there are also things that can kill a deal from the outside, no matter how good the property is. For me, that's HOAs. I avoid HOAs because if there's an HOA, there's a group of people, right, telling you what you can and cannot do with your property. They might say you can rent it however you want, you can do whatever you want. They can tell you whatever, or their bylaws for the HOA, the rules might say you can rent by the room, whatever. We have no restrictions. However, at any point they can vote and change the rules and then restrict occupancy. They can shut down your business model with a single letter. I don't want to deal with that. It's just not worth my time and energy when there's plenty of opportunities that don't have HOAs and rental restrictions. Same goes for markets that have strict occupancy enforcement in their local ordinances. If they're telling me I could only put 4 people in a house in this market, and they're constantly stopping rent by the room house, rent by the room house, rent by the room house over and over again, they're enforcing those local ordinances. That's another no-go. Why would I want to invest in a market that does not want me to invest in there, or makes it so hard to invest in there, which is implying that it's not a great market to invest in? So always check those local rental laws. It's not exciting due diligence. It's not an exciting item. It's due diligence. But skipping that is how investors lose deals that they've already closed on. Because once that happens, if you're banking on high co-living income, but you're investing in a property with an HOA or very strict occupancy enforcement, well, you just bought an investment that's supposed to generate you great returns, and now it's been shut down after you spend a bunch of time, money, and energy to acquire that asset. You don't want to do that. So the right market, but then breaking it down further into specific characteristics that I filter saves me a ton of time and energy to not make bad investment decisions. Rule 2 is understanding what the right property looks like, at least the right property for you based on your investment strategy. I'll talk about my investment strategy. The right property is where most investors leave money on the table, or worse, they buy something that will never actually hit their targets no matter how well they operate it. You might have bought it right, and you might even operate it well, but you might have just bought the wrong property. It won't succeed. My minimum for co-living is 6 bedrooms after conversion. If it's less than 6 bedrooms, the cash flow rarely clears my goal of $1,500 a month in cash flow per co-living property that I buy. From my rough estimates, really market dependent, but if it's a property that has 6 bedrooms, I anticipate that I will roughly make between $500 to $1,000 a month of cash flow. Then I got to analyze the property in detail to validate that. Like I said, it's very market dependent. Well, if it's 7 rooms, I'm thinking I can get closer to $1,000 to $1,500 a month. Well, there's a reason why I buy most of my properties at 8, 9, 10 bedrooms, because that's when I'm getting $1,500 to $3,000 a month of cash flow per property. This is why I specifically target 3 to 4 bedrooms with at least 2,000 square feet. Because if there's already multiple bedrooms and a couple bathrooms as well, I know I'm only a few low-cost conversions away from creating a 6, 7, 8, 9, 10 bedroom co-living property, generating me $1,000 a month in cash flow. Like I talked about, it's not about buying as many properties as possible. It's about efficiently achieving your financial freedom. Well, how do you do that? You do that by finding, structuring, and buying the best investments out there, which is why I like that larger bedroom count. I could buy smaller bedrooms, but it's not ideal, because if I have that 4-bedroom, 3-bath home with at least 2,000 square feet, I'm almost certain that I can convert a couple of the common areas, depending on the layout, dining rooms, living rooms, bonus rooms, offices, things that can become bedrooms through very low cost conversions. And by low cost, what I'm referring to is maybe adding 1 or 2 walls and a door. If it's an office, sometimes all I need to do is add a door. Sometimes it already has a door. All I need to do is add an armoire as the closet and then furnish it. Well, if it's a living room or a dining room, depending on its size, we're adding 1 or 2 walls and a door. And for under $6,000, we converted a space that's not going to be utilized in the co-living home into another rental income source without just cramming too many people in there, I guess. It's the combination. That's why you want bigger properties, not trying to, I see people take 1,500 square foot properties and jam 8 rooms in there, but they're compromising so much for their tenants. The rooms are too small. They're not insulating them well. It's not the ideal strategy, as opposed to finding bigger, better properties that have easy, low-cost conversions to co-living. For most of my properties, that's the whole conversion strategy. Take living rooms, dining rooms, bonus rooms, offices, and for less than up to 2 walls and a door, I've got another bedroom. So converting that one common area to a bedroom runs between, $1,000 to $6,000, on average $5,000 to $6,000 for those 2 walls and a door, and much lower if you're just adding a door. Obviously, virtually nothing if it's just an armoire. That's how much it costs. I prefer that because I can get, let's say, 4 extra bedrooms for under $25,000, right? Around $25,000, where if I was to buy a property and do a full gut renovation, fully renovate it, add the rooms and maximize the square footage by rearranging everything, that can cost me $100,000 or more and take 5, 10, these are weird, 6, 12, 18 months in renovation. 18 is a little excessive. That's more of like a new build. But it's going to take a quarter to a year to do this full renovation, cost me a lot more money, have a lot more risk to create the ideal bedroom count. Why would I do that when instead I could just buy properties that are already really nice, ready to go, and convert some of the common areas, because I understand the strategy that no one else is looking at. When a homeowner is looking at the property, they're not thinking of that. Most investors are not thinking of how can I convert this into a cash flow machine. Well, that's the value that you get as someone who understands the strategy, so you can do it yourself as well. This is the value that I put into the space, because this is what I apply. I'm looking at properties. I'm not buying them for them being great deals as is. I am finding a property that has the right foundation to be effectively converted into a cash flowing machine, diversified cash flowing machine of a co-living investment. And I'm minimizing my risk by minimizing my renovation costs and timeline. So it's a much smaller scope, going to cost me a lot less, take a lot longer. So if something does go wrong, a 10% margin of error is virtually insignificant for a low cost conversion, as opposed to $100,000+ full gut renovation. I stay low cost on purpose. That allows me to control the risk and accelerate the returns. There are 2 additional non-negotiables beyond the bedroom count. Parking. I want around 70% of my tenants to have access to parking right then and there, easily accessible. Why? Because parking conflicts are one of the top drivers of tenant turnover. It's a cost I don't want to pay because I bought the wrong property and I was not able to provide them sufficient parking, or they have to park in front of the neighbor's house and all that stuff, which leads to issues with your neighbors or tenant issues because there isn't sufficient parking. Both of those are more work than are necessary to achieve my overall goal, because it's not just about maximizing my cash flow and returns per property, but it's also about minimizing my operational headaches per property. If I'm doing co-living and we have multiple tenants in one house, the goal should be, how do you minimize tenant issues, tenant turnover, so your operations are as efficient as possible for the properties that you do own. So it's not just about minimizing your operations by buying less but better deals. It's about structuring your properties effectively so they are less headache for you to own and operate, even if you have property managers in place. Like I said, parking is one of those issues that I've seen with my portfolio as well as others, where that could become an issue for people and lead to tenant turnover issues. And that, most importantly, leads to turnover, which has a huge cost. Not only they move out, takes time to repair whatever needs to get done. There's vacancy, someone new moves in. That's a cost I'm not trying to pay if I don't have to. And then bathrooms. Like I said, bedroom count, parking, and bathrooms. You don't want more than 4 people ever sharing a single bathroom. Ideally, no more than 3 people are sharing the same bathroom, but 4 is the max. Bathroom congestion drives move-outs faster than almost anything else. Before parking or anything else, bathroom congestion drives move-outs faster than almost anything else. If too many people who are working professionals are trying to get ready at the same time, and you're trying to put too many people for a lack of bathrooms in there, you're going to make it really difficult. So we set the rules that we're not trying to buy properties that have more than 4 people sharing one bathroom, ideally 3 at the max. But we're also setting up the rooms so that people can actually get ready in their rooms and only utilize the bathroom spend less time in the bathroom while they're getting ready. What does that mean? So we give them large full-length mirrors in their rooms. We set the properties up and their rooms up effectively so they can get ready, provide them the supplies they need in their room so they can get ready effectively in their room and only spend the minimum amount of time necessary in the bathroom when there are multiple people sharing a bathroom. The thing is, both of these are incredibly easy to screen for on a listing, and they will save you thousands in downstream headaches, not only financially, but also the operational costs involved with it. And last but not least is the right operations. This is the one most investors underestimate until they've been burned by their lack of operations. When I first started scaling my portfolio, like most people, I thought the spreadsheet alone was sufficient. However, I had a property that we consider cutting corners on. So this was a short-term rental converted to co-living. Short-term was the plan for it. We had to pivot out from it. And so we said, okay, let's add this one wall. Very first co-living deal. Not thinking about noise insulation, the fact that it's close to the living room and bed, kitchen, just like right up on it. Didn't think about any of that stuff at the beginning. We also set up with furnishing because we were trying to really minimize the conversion cost. That meant a smaller bedroom with a smaller bed, not as good of a mattress, skipped a few furnishing items that we incorporate on every single one of our deals now. We decided not to stock shared supplies. These are all the things that I learned to implement now. And on the spreadsheet, it actually looked fine. It looked way better. I was saving a few $100 up front. It was going to have no impact on the spreadsheet, on the amount of income I can charge, the vacancy, the turnover, none of that. Because on the spreadsheet, it's the same income, same expenses. The only difference is my cost for conversion, or let's say instead of being $10,000 was $5,000. So I was saving $5,000 up front. That looked good on paper. Well, online on the spreadsheet. But what happened in practice was that the tenants started moving out faster. They weren't there for the long term. They were there temporarily, especially the room that was right next to the kitchen without the noise insulating walls. There were walls, but they were not insulated well to minimize noise. The door was not as much of a consideration to make sure it's extremely flush. The location, all this stuff, between the bedroom size, the way the walls were set up, the furnishings, this room in particular had the most turnover. It took the longest time to fill, did not have great feedback from the tenants, and we made much less income on this room than the other ones in the exact same house. Well, the problem with that is every single time a tenant leaves, you're paying for that. Vacancy, while the room sits empty, you're paying for that, right? Your loss of income is an expense at the same time, right? Because if it's less profit, whether it's an income issue or an expense issue, it's less profit overall. The turnover costs were an issue. The cost to clean, repair, relist, waiting for the property to get filled, right? Not just the vacancy, but then also the longer fill time because it took longer to fill it because the listing wasn't as competitive as the others in the same house or just in general. And that leads to more vacancy. It's this messed up cycle that compounds very quickly. That less than $5,000 in savings cost me thousands of extra dollars in turnover. As a result, I broke down the entire process, understood what makes the most sense for my tenants, what is the most ideal, and then I made sure that we were never going to cut corners on operations again based on a spreadsheet and using more so common sense that becomes more common as an actual owner operator of these properties rather than just saying, okay, this is what we're going to do. This is what it is. I'm going to do whatever's the lowest cost in the spreadsheet because it shows my numbers are better. If you're showing $5,000 less entry, it seems better on the spreadsheet. Well, just a lie. You have to actually have context and comment and like sense around this decision. It's not just the spreadsheet thing. It takes more. It's a holistic approach. I'm telling you right now that the investor generating the best returns on co-living are not the ones who minimize their investment in the property. I'm telling you right now, though, at the same time, those who are showcasing, they're cutting corners, they're not insulating the walls. Sure, it's going to save them a little bit of money. They're not furnishing the room well. Sure, it's going to look better. So on the spreadsheet they're sharing with you, or they're not accounting for maintenance and reserves and that kind of stuff. Sure, it looks better on a spreadsheet. But in reality, those that actually own properties and are generating the best returns in co-living investing are not the ones who minimize their investment in the property on the spreadsheet where it looked good on the spreadsheet. It's those that became great stewards of it instead. Those that became great stewards of the property, not just those that are trying to maximize their investment returns by minimizing their initial investment in the property themselves. So it's going to look better on a spreadsheet. It's not the reality. And it's only a small difference in the grand scheme of things. Trust me, it is so much better for you, for your property, for your tenants, if you actually project the correct renovation costs, the correct furnishing costs to allow your properties to be set up as operationally effectively as possible to maximize income, maximize tenants staying there longer, to provide a better quality product, a better quality room, a better quality house to your tenants, than those who are just trying to cut corners and being a slumlord to make it work. So what does that mean to be a great steward of it? Setting up your rooms the right size. They're at least meeting the right size requirements, that they have the right bed size or better bed size. They have better mattresses. For us, we really love to include desks in every single room that we can. Clean common areas, shared supplies stocked every month. Yeah, it's a cost. It costs us $20 to $40 a month, depending on the property and the number of units. But for spending under $45 a month on shared supplies at most of our properties, for like trash bags, dish soap, hand soap, paper towels, toilet paper, that $45 being spent is me being a great steward. Why? Because I'm removing one of the biggest, most common friction points between tenants. And one of the most common reasons people leave. We talk about parking, bathroom, but then who's supposed to restock paper towels? Does everyone have their own in their room, or what are we doing here? Well, that $45 is not a cost for me. At $1,500 to $2,000 a month in cash flow, that $45 is not a cost. It's a retention multiplier, right? So it's not about, it's coming from my cash flow. Yeah, of course it is, right? The projected cash flow. Well, projections are great until you actually own the asset. What matters is how much are you actually generating? So it's a retention multiplier. So instead of generating on paper $1,500 to $2,000 a month plus 45, so let's say $2,045 a month, I'd much rather make $2,000 a month, minimize as much of my tenant issues as possible, meaning my tenants are staying longer, and that actually means I'm generating way more money every single month than would have otherwise. It's this magical thing where being a slumlord always looks better on paper, but the reality is to be a better property owner, a better manager of your tenants, provide them a better, more valuable product, minimize the operational headaches that result from being a slumlord, because that actually generates you way more returns over the long term. The cool part is that we're not just buying properties that make massive cash flow, right? We're also buying properties in these great markets, great properties. And my properties are great homes. They're not boarding houses. Yes, we talk a lot about the cash flow. It makes you financially free, but I get a 5-to-1 boost basically for every dollar in cash flow. I get $5 that are generated through wealth building, through property appreciation, through debt pay down. So my big focus is buying great properties in great markets that work well for co-living, that generate me a lot of cash flow, that continue expanding my financial freedom. But just as importantly, these great properties result in lower operational headaches and massive wealth building. This is how I'm able to have tenants stay with me for years. That long-term retention is what keeps vacancy near zero and income consistent, even when the market is shifting or there's more and more properties out there. If you take care of your properties, if you take care of your tenants, that's basically the whole philosophy. That's being a great steward. And I'm telling you, no matter what the spreadsheet says, Being a great owner of your properties, being a great owner to your tenants is much better for you financially and operationally. So you can make more in reality, not just on a spreadsheet, but in reality with less headache involved, which is the goal. How can I make more with less headache? That's why we buy one co-living, not 10 plus long-term rentals. Well, if you're buying two co-living properties, well, I'd rather invest the extra $5,000 to make this a better property that keeps my tenants happier and they're longer and tenants moving in faster, because that's operationally way more advantageous for generating that same cash flow. But if I'm putting in less time and effort, even though I had to put in a little bit more money up front, it's way better. I guarantee you. So the co-living deal filter. This is how I minimize the amount of time wasted on any single deal that I'm looking at. I want to give you one of the most practical frameworks that I'm using every single day when I'm looking at properties. This alone will save you hundreds of hours. How do I know? Because it saves me hundreds of hours on every single deal that I look at. Because one of the most costly mistakes I see investors make is spending hours, if not days, fully underwriting a deal before they even checked, does this qualify for my buy box? Does this even make sense for co-living? This was, let's see, what's a great one? I can talk about HOAs, I can talk about parking, I can talk about all that stuff, but the 5 layers that I consider going in order, I go through this 5-layer sequence, I go through them in order, and then I stop if something fails because there's no point of moving down. It's a literal funnel of deals, and then I say, okay, do I want to move forward with this deal or not once it makes it through? If it fails at any part, it's done. I'm not wasting my time and energy, especially I'm not doing the full deal analysis until this stuff makes sense. So layer 1 are my quick disqualifiers. This takes me less than 5 minutes. Is there an HOA? It's done. If there's an HOA, I don't want to do it. Is there not an ideal parking layout for this property? If it is, great. I don't want to deal with it. Are there occupancy laws in this market and are they enforced? If it is, great. I don't want to deal with it. Is there a solid enough layout where I see the possibility of at least making 6 rooms? So either it has large enough square footage or already starts off with a sufficient number of bedrooms and bathrooms. If not, kill it, move on. In my opinion, this is the most important filtering mechanism. So you're not wasting all this unnecessary time and energy analyzing deals, spending days or hours, days, maybe even weeks. Sometimes people are looking at a deal trying to get all the information when they could have just killed the bad deal and moved on and found 10 more opportunities instead. So layer 2 is market fit. If it's an automatic, no HOA, no this, no that, whatever, I want to make sure it's the right market. Is there a core pass? Is this a core pass split market already? Is there documented demand? Are more people looking for co-living housing, rent by the room housing, than there is current supply available? If it's no to either, if it's not a core market, or there's less demand than there is supply, if less people, there's more houses available than people looking for housing, well, I'm going to kill it. It doesn't make sense. So if it's no to either, if it's not an established market, or there's not strong demand, I'm going to move on. I don't want to try and pioneer a market. Let the platform, let other investors take the risk and validate that market first so that I can instead focus on markets where this already works well. Why waste that time and energy? I don't get bonus points for being a pioneer. I get bonus points for buying the right properties and making them effectively generate cash flow and build wealth for us, not by being the first person to do something. That's actually how you just introduce more unnecessary risk. All right, layer 3 is property fit. This really goes into, can this property reach 6 or more bedrooms through low-cost conversions? That means, does the layout support it, right? Is the square footage, the current bedroom count, the available common areas, does the layout, the structure of it support this low-cost conversion to at least 6 rooms? Is the parking workable? Is the bathroom ratio manageable? The number of bedrooms sharing a bathroom manageable, depending on the number of bedrooms I'm going to end up with once it's all said and done. For me, if I can get to 6 bedrooms at least without a massive renovation, I'm going to move on. If I can't get to at least 6 without a lot of renovations, I'm going to move on. It's not a deal for me. Layer 4 is operations. Will tenants actually want to live in this area, in this property? Will they want to live there? Am I furnishing it well enough for them? Is that part of my plan? Or am I having to cut corners on the renovations or furnishings to make it something that they would consider living in? At the same time, is the renovation scope manageable, like I said, without cutting corners? I have to cut corners to make this deal work, or am I buying the right deal where the numbers do work well and I'm just deciding, yes, let's move forward? Does this property have the right bones? Like I said, market, right? The state, the city, the neighborhood, the street. Does it have the right bones to attract and retain good tenants long term? Does it have the right employment around there as well? And then layer 5, once I've established all these other things, quick disqualifiers, market fit, property fit, and operational considerations, then and only then will I run the full numbers, the full analysis on a property. That's when I'll do the full deal analysis and say, does it hit $1,500 a month of cash flow? Does it clear 15% cash on cash return? And then for me, does creative financing dramatically improve the numbers versus conventional? So if there is the possibility to buy a great deal conventionally, traditionally, using a new loan, DSCR loan, conventional, whatever, if I can make it much better through creative, or it's already creatively financed and I could further improve it, I'm going to get to that point during deal analysis. So only after I go through those first 4 layers do I even consider deal analysis. And once I analyze it, I'm thinking, how do I improve this deal? So once again, I'm buying better deals. If I can make $1,000 as is, but I can improve it, improve the deal terms, so instead of making $1,500 or $2,000 a month, great. That's one less property I have to buy in my portfolio to be financially free. It's not about buying a bunch of properties. It's about buying properties that generate you high cash flow and cash on cash return. Okay? That's the whole thing. It's how can I get to my overall goal, the least amount of properties, what I'm really trying to emphasize for you. And it goes through various layers. It's finding the right properties, but just as importantly, how do I make that the best deal once I found an opportunity before I close on it? For me, and I think you should consider this as well, your most valuable resource is your time. Every hour you spend on a deal that never even qualified is an hour you didn't spend on the one that does. So please, my recommendation is run the filter test every single time without exception. You're going to save yourself so much time, energy, and effort. Instead of going down the rabbit hole for wrong deals, you're going to save that time and energy for the right opportunities instead. And creative financing is that second layer that really adds so much extra value to the deals that I'm buying. It just isn't even comparable. It just makes the deal terms way better. So we're going to stack the second lever, right? We talked about CoLiving. Well, now it's creative financing. CoLiving drastically increases your income per property, but creative financing dramatically increases your returns on that income by reducing how much you have to put in and how much you're spending each month on that deal. Lower down payments, lower interest rates, resulting in higher cash flow. When you combine both, CoLiving, higher income, plus lower expenses, you're just doubly increasing your cash flow. When you're reducing the amount of money you have to put in, you're massively increasing your cash on cash return. You're pulling the 2 major levers for real estate investing simultaneously through this, increasing income, reducing expenses, and reducing entry costs. It's like magical what it does to your deal returns. And the results are a completely different tier from anything else a conventional investor can produce. If they're going long term, it's not even comparable how much better CoLiving is. Well, if you're doing CoLiving, but you combine creative financing to it, well, it's nothing comparable. Creative financing greatly exceeds conventional real estate returns because instead of putting 20 to 25% down payment, having strong W-2 income, having strong credit, and paying higher interest rate through a traditional loan to buy an investment property, that's just like one path. It's not the only path. Instead of doing that, the goal is to build towards your freedom efficiently. Doing that is not the most efficient path. It's not the best path, just speaking by the numbers alone. Buying property subject to, so taking over someone's existing loan, typically with lower interest rates, very low down payments, or seller financing, where the seller is the bank. So you have lots of levers to pull from instead of working with a bank who's just telling you this is how the deal returns are. If you're buying those properties, leveraging creative financing, subject to seller financing, combining them, seller financing plus a new loan, whatever creative strategies you're applying, that lets you acquire those properties with less capital down and at interest rates that are far below what banks are charging you. If I have a $350,000 loan at 7% interest, that's $23.28 per month for that loan payment. Well, if I have the exact same loan, $350,000, but instead of at 7%, it's 3% interest rate, that's $14.75 per month. That monthly difference between 7% versus 3% on the same exact loan amount is $853 per month. $853 more cash flow every single month buying it creatively than traditionally. That translates to over $10,000 more of cash flow per year. This is how you are buying better deals. You're finding the deal and then you're making it a better deal. So buying better deals is kind of a misnomer. It's finding opportunities and then structuring them effectively to be the best deals before you close on them. That's how you go from potentially making under $1,000 to almost $2,000 a month of cash flow, generating you $10,000+ of cash flow per year, meaning you achieve your goals with less properties and less overall time and effort. That should be your goal. This has always been my goal. This is what has allowed me to achieve such massive results in the time frame that I've done it by thinking this way. That's why I'm always grateful for my engineering background. That $853 a month is massive. Even an extra $200 a month is massive. Let alone $800 a month. That's for a long-term, like a traditional rental, traditional landlord. That's potentially 8 properties of additional cash flow through one simple tweak in your investment strategy. I'm not saying it's easy to structure creative financing. I'm just saying this is what you are able to do and the results of it if you spend more time trying to structure better deals rather than just buying a bunch of properties and saying, hey, I'll just make up the 853 through 10 more investments, as opposed to how can I make this one co-living deal even better? That is intentional freedom creation measured in monthly cash flow, because that's all financial freedom is. Monthly cash flow to cover your expenses. This is you doing that intentionally. Now you stack that on top of the additional co-living income, and it'll producing $1,700 a month under conventional financing will now produce you over $2,500 a month with a creative structure. This is how you massively shorten your path to financial freedom on every single deal that you close on. A simple example is I buy plenty of deals at full asking price. Let me walk you through one of my deals, another deal in Atlanta. This was another 4-bedroom, 3-bath property. Very motivated seller who'd been on the market for 150 days for this property. He's been trying to sell it. What is 150 days? 5 months. It's been sitting there. Every single investor who came before me, who tried to make an offer on this, tried to beat the price down. That was their tool in their tool belt. The seller had listed it for $460,000, and other investors or homeowners were trying to buy the property with lowballer offers. The seller would counter and nobody was moving, because for the investor, they needed to buy at a lower price with the high interest rate to make it make sense. Well, for the seller, they didn't want to lower the price. At least not anything that would drastically reduce the monthly expenses to make it make sense for an investor. So they went from $468 initially to $454,000, so $14,000 difference in 5 months, and people were lowballing that. Well, and I came and my offer was for their full asking price. Not even the $454,000, but the full $468,000. Why would I buy the property for $14,000 more than what they had it listed for? Because that $14,000 was what allowed me to effectively create a great investment opportunity. The seller was so massively surprised that I not only offered the full asking price, right? That was the big thing, but their original asking price. While everyone else was lowballing them, I did the exact opposite. Instead of trying to buy a $454,000 property, $440,000 or $430,000, which probably still would have sucked, I did the opposite. Why? Was because price was not the lever I was pulling. The terms of the deal were. I was able to offer them $14,000 more than others, but instead of having to go to a bank requiring 25% down payment, well, the seller owned the property almost outright. They had a small mortgage left on the property, under $20,000, and we agreed on a 10% down payment on the purchase price. So the $468,000, $46,000, $800 down payment, they used that to cover the remaining mortgage, and they seller financed the rest to me at a 0% interest rate, where if I went and did a 25%, even on $400,000, let's say I dropped it from $454 to $400, well, 25% on $400,000 is still $100,000 on the down payment. So I saved over $50,000 on the down payment, but I massively saved thousands of dollars a month on a much lower interest rate, which led to a much lower monthly loan payment. That several $1,000s a month was created by offering $14,000 more on the purchase price. It's a give and take. So I offered $14,000 more on the purchase price to the seller, going creative what that did was that saved me over $66,000 in the down payment. And my monthly payment was over $1,000 less a month than a conventional loan. That's more than $12,000 in additional profit every single year, and I saved over 50% upfront. And not only am I making way more cash flow, we're also paying down the debt 100% every single month with that interest rate, as opposed to wasting tons of it on interest on a 7% loan. Then we did the co-living conversion. Converted the dining room, the living room, and the office into 3 additional bedrooms, making it 8 total bedrooms. The renovations and furnishings on that property cost me $28,500. Closing costs were just under $10,000 because seller financing is not a very expensive closing. And there's no agent involved, nothing at that point. We set aside $8,000 in reserves. So my total all in for purchasing, closing, renovating, furnishing, and reserves was roughly $94,000. That is less, that my all-in costs were less than if I bought the property with a new conventional loan itself. That would have been $120,000, just the down payment. Well, instead I bought the property for $94,000, closed on it, renovated it, furnished it, and had reserves for lower than just the down payment alone on a traditional investment. And if I bought that property conventionally, even with a much larger down payment, because of the higher interest rate, I would have made around $770 a month, which is around a 5.7% cash on cash return. For a lot of investors, just doing that puts them on another stratosphere compared to the majority of investors. It's already a good enough deal for the majority of people working in this high interest rate, high housing price market, especially when all they're used to is long-term, short-term, and mid-term rentals. Well, the co-living already made this a much better deal. $770 a month, 5.7% cash on cash return. Well, combining that with creative financing allowed me to generate $1,851 a month and 23.7% cash on cash return. So I over doubled, almost 2.5 times, right? 2.5 times the cash flow. And my cash on cash return went from less than 6% to over 23%. This is how you achieve your goals through real estate much more quickly and efficiently. If you think about it, at $1,850 a month in cash flow, how many of those properties would you need to generate $10,000 a month in cash flow? What's that, like 6, maybe 7 properties allow you to be financially free through real estate if you're buying deals that are generating you $1,500 to $2,000 a month in cash flow? Not 50, right? Not hundreds, less than 10. And every single deal you close on makes the next one easier because you're also building your network. It's deepening, your systems sharpen, and the momentum continues to compound on itself. So you're learning and improving as you're finding, structuring, and acquiring deals. And then you're getting better and better operationally as you are deepening your network and your system in that market, while your skills are also compounding as well as your momentum. What I'd love to know from you guys who are live is, where are you right now? Are you before your first deal? Are you working on your first? Do you already have properties? You converting properties that you own? Do you already have co-living? Looking to optimize your co-living? Where are you at and what are you struggling with? So I can try to provide you the most value that I possibly can. All right, so with that, I want to leave you guys with something before I call it for the day. And I want to say it very clearly because I think it gets lost in a lot of investing content. Freedom is not about your door count. It is not about the number of properties that you own. It is not about your portfolio size, the dollar amount, the number of properties, the number of rooms. It's not about the number you post on social media, even though people love to post on social media, including myself, who shares my portfolio to help you guys out. Freedom is about generating efficient cash flow. It's about how much your property produces relative to what you put in to build those investments. The question for me is never, how many properties do I own? For me, the question is, how efficiently do my properties create freedom? How efficiently do my properties that I'm investing in create freedom? And when I find those opportunities, how can I make them that much better on every single deal that I'm doing? When I committed fully to my strategy, I stopped spending time chasing volume. My goal was not to find every single potential investment opportunity, analyze it in full detail, waste all this time and energy on that to find hundreds of deals to buy. Instead of trying to close as many deals as possible, I invested that same time into 2 specific skill sets. finding and structuring great creatively financed deals, and identifying and converting co-living properties as effectively as possible. These skills did take me time to develop. There is honestly no shortcut through that, although, well, that's not true. These skills take time to develop for you, but there are shortcuts to achieve that depending on where you're at in your investing journey. How did I shortcut it? I learned from mentors who already built what I was trying to build. However, there wasn't this education involved with co-living or acquiring co-living creatively financed investments, especially the way that I do so. So I had to kind of create that. It took me time to develop these skills, but I had to put in the work. I had to execute. I iterated, which means I continually tested it and improved the process. And I improved deal by deal by deal. That combination is what compressed my timeline and allowed me to build my big portfolio in just under 5 years. Not because I had the most capital when I was starting out or because I worked every single hour of every day. It's because I had the right system and I applied it consistently to the right opportunities. Every time I closed a better deal, the next one got easier to find, structure, and execute. Closed on that one, then the next one got easier to find, structure, and execute. Just keep doing the process over and over again, continue improving that. Education is what helps you fast track that process. So I give you guys so much free education and value, but I also have the co-living freedom community. Your goal is to have that step-by-step roadmap to your first or next co-living deal. I actually see several people here who are live today. Some people who, congrats to Alicia for closing on her second co-living deal yesterday. Wow, it's only been a few months since you closed on your first. Incredible. I don't know this name, but working on my first co-living deal, and it's a creative sub-2 deal. Love that for you. Some others are currently bird dogging. Those of you who are actively buying deals, whether it's your first or next co-living deal, that's the co-living freedom community. If you are already buying properties or you know how to do so, or you have capital, right, reserves, well, that's what the super investors community that I have is for. It's to help you efficiently implement the deal system, the money system, and the operation system to grow and scale more efficiently towards your financial freedom. So here's what I want you to walk away with today. Set your target. What is your real freedom number? How much money do you want to be generating each month to be financially free? Then build the core skills. How can you find investment opportunities, like the deals, right? It's finding prospective opportunities, analyzing them, and then structuring them to be the best possible deals for putting them under contract or during due diligence. That's the deals. Incorporating creative financing to that is how you make them better. Once again, understanding co-living operations, not just for the actual management, but when it comes to setting up your properties for massive success. Focus on that piece, because then you have capital, you have operations later, but focus on finding opportunities, deal analysis, creative financing, co-living operations, right? For the types of properties you're looking for, build those skills if your goal is to find investments and then to make them the best deals possible. The goal is to buy better deals, structure better deals, not buy more deals, better ones, not more, but better. Because the path to financial freedom gets so much shorter every single time that you do. Every single time that you dedicate more time and energy to finding better opportunities or structuring better deals, you are fast tracking your path to financial freedom through real estate investing. Co-living already does that. Creative financing compounds that effort that you're putting in. And the major next unlock is how do you buy more and more deals? Well, it comes from raising capital. So that as you earn, save, and invest your money, you're raising money, providing great investment opportunities to other investors. So with that, the way I help you guys, free co-living challenges, you're always welcome to do that. Free real estate investment community, which includes stuff for bird dogging, co-living, all that good stuff. Free deal calculators, free community, co-living freedom community if you're looking to get more step-by-step guidance. And then obviously on social media. So with that, thank you guys. Hopefully you got a ton of value. This took a pretty solid amount of time and energy. Put all this together for you all. So I hope you got a lot of value. And I'll see you guys next week. And for my friends that I will see in San Antonio, see you guys soon.